Have you ever heard the phrase buy the dip and wondered what it really means? When the market drops, some investors panic, but others spot opportunity. In this video, we'll break down why buying the dip can be a smart strategy if you know how to use it wisely. Let's turn market fear into your financial advantage. A quick disclaimer: I am not a financial advisor. The content in these videos is intended for educational and informational purposes only. Always do your own research and consult a licensed financial professional before making any investment decisions. So, what exactly is the buy the dip strategy? It's an investment approach where you buy stocks when their prices drop, not when they're climbing. The stock market moves up and down regularly. That's called volatility. Sometimes prices fall sharply for a short period. Investors using this strategy see those drops as a chance to buy strong companies at a lower price. The idea is simple: buy low, sell high. But knowing when to buy, that's the real challenge. Some investors wait patiently for weeks, months, or even years for a significant dip. They don't rush in when prices are high. Instead, they keep cash on the side, ready to act when fear grips the market. When a major dip occurs, they invest with confidence, aiming to profit from the recovery that often follows. Once they've bought during the dip, these investors wait for prices to rise again. When the market rebounds, they sell at a profit and set aside the gains to repeat the process next time. It's a long-term mindset, staying calm when others panic and using downturns to your advantage. That's the strength behind the buy the dip strategy. What are the advantages of this approach? The biggest one is price. Buying during a dip allows you to get quality stocks at a discount. Over time, this lowers your average purchase price, and a lower average means you need less upward movement to make a profit. It's a smart way to strengthen your portfolio without overpaying. Lower costs lead to higher potential returns. When you invest at a lower price, every gain that follows works harder for you. Even in a volatile market, this can boost your long-term performance. Instead of chasing stocks when they're expensive, you wait for better entry points. That's how disciplined investors maximize their results. So what are the downsides of buying the dip? First, dips don't follow a schedule. You might wait weeks, months, or even years for a real opportunity. This strategy requires patience and discipline. While you wait, your cash isn't working. It's just sitting there. That means you could miss out on other opportunities in the meantime. Another risk? Missing market growth altogether. If the market keeps rising and the dip you're waiting for never comes, or it's too small, you may underperform. In many cases, a strategy like dollar cost averaging, DCA, where you invest steadily over time, might deliver better long-term results. If you're curious about DCA, check out our other video where we walk through that strategy step by step. And finally, not every dip is worth buying. Sometimes a stock drops because the business is in real trouble, and it may never recover. If you buy into a company without doing proper research, you risk locking in a loss. That's why it's crucial to look beyond the price and understand the business behind it. A dip isn't always a deal. That brings us to the end of this video. If you found it helpful, don't forget to like and subscribe to the channel. There's plenty more clear and practical investing content on the way. Your support helps us to improve the quality of the videos. Thanks for watching, and see you in the next video.